Ladies and gentlemen, welcome to this week's version of Nickels and Dimes, our weekly video series. This week I'm going to be talking about an article that I thought was fantastic. It's quite eye-opening, written by Wolf Richter, who publishes a website, wolfstreet.com. So again, wolfstreet.com. And it's interesting because he highlighted one of the metrics that we look at to determine risk in the marketplace, and that's something known as margin debt. So most of you know that margin, meaning borrowing against your portfolio, of course, to buy additional shares, is a metric that could be very concerning if the levels are excessive. So no one cares about debt and leverage, frankly, when the underlying asset that debt is invested in does well. So in other words, if you borrow money and invest in an asset that's going to appreciate, all's well and good. But we all know that sometimes that asset that you're investing in, with that loan does not participate in the upside. Obviously, that's part of the reason why people lose money, because maybe that investment is depreciating. We saw that, when we had excessive loans and, prior to the dot-com crash. I'll show you a chart today that emphasizes that. We saw that when people took out many mortgages to invest in real estate back in 04, 05, 06, back in, the housing craze. What we're seeing right now is excessive margin debt. So, and I'll show you two charts that provide some clarity on that. Here is a change in margin debt from a year ago. So this is like 2019, 2020. You could see there was very low levels of margin debt. You could see since March of 2020, when the market bottomed and has obviously skyrocketed since, you could see how much margin debt there has been. You talk about an extreme run. Okay, so let's talk about some numbers, and this is kind of eye-opening, right? So FINRA, the Financial Investment Regulatory Agency, referenced in February margin debt jumped by another $15 billion to $813 billion. So over the last 4 months, margin debt has soared by $154 billion, a historic surge to historic highs. So let's look at another chart, and this again will be eye-opening. This chart spike in margin debt. So again, how does a spike in margin debt subsequently affect the equity market? So this is in the dot-com years. So you had a spike in margin debt over here. Okay, that again in 1999 that led to part of the reason that that we had the dot-com bust. So spike in margin debt, and then we had the markets tank, and from September 2002, the S&P in that time frame was down 50% from the peak of 2000, and then you had spike in margin debt, right? And then you had the financial crisis. We all we all went through that, where the S&P from the peak dropped 56%. Many years later, over the last 10 plus years, margin debt spiked, and then obviously we had the big correction at the end of, for example, 2018, the last quarter of 2018. And again, look at the spike in margin debt now. It is basically a parabolic move up. Now, I'm not saying that we're going to see that subsequent decline in stock prices, but as they say, the markets in history doesn't repeat itself necessarily, but it often rhymes. So something to look at. Now, why am I bringing this up now? Not only because this is what we're dealing with now when we look at actual, metrics and debt that we're seeing in today's marketplace, behind the scenes if you're paying attention. But the question I have for you is, and if you're a client, you know this, we always talk about risk management. Is your portfolio positioned that if the margin debt ends up rearing its ugly head in terms of falling, and potentially, collapsing equity prices as we've seen in the past, is your portfolio positioned to withstand or protect on the downside? Now, traditional asset allocation historically has worked, but for example, in 2008, we referenced the market was down over 50% from the peak. Traditional asset allocation portfolio, according to Morningstar, was down about 28%. So most retirees, as an example, don't want to have a portfolio drop even with a traditional asset allocation. So my point in all this saying is that even if you have a traditional asset allocation model or portfolio where you have a mix of stocks and bonds, it may not be enough to protect your portfolio. from losing big if we do see a big downside again. Again, I'm not saying that to scare you. I'm saying that to awaken you about reevaluating what's going on in the marketplace. Sometimes when the markets are good, which we've seen since the March 2020 lows, people tend to get complacent. Do not get complacent. These are real facts. We see how it affected the market in the past. The question is, will it affect the market in the future? I have no idea. No one does. But again, it's something to look at and to consider in terms of how it will affect you. To that end, if you would like a second opinion on your portfolio, you could send me an email, cnichols@nicholswealth.com, or go on our website at nicholswealth.com. Check out the services tab, click on second opinion service, and we're happy to meet with you to give you a second opinion. Thanks again for watching. Bye-bye.